Bloomberg FX Masterclass, brought to you by FxPro. Trade Forex like a pro.
Modern-day currency traders still keep a close eye on something that's been a benchmark of value for thousands of years: gold.
Generally, gold is kind of viewed as like the anti-dollar kind of trade, that whenever you think the dollar is very weak or you think the Fed's printing money, then gold tends to do very well.
I would say pay a lot of attention to gold because it's an overall barometer of whether people like the dollar or don't like the dollar.
If you don't believe in the U.S. economy, you don't believe in the U.S. dollar. That's sort of the psychology behind gold as the inflation hedge.
If gold goes from $1,000 an ounce to $1,100 because you're worried that the Federal Reserve won't be fighting inflation and people leave financial assets and go to hard assets, and gold is a hard asset.
But beware, the inverse relationship between the dollar and gold, one goes up when the other goes down, sometimes falls apart.
Classic example, at the beginning of the financial crisis, we saw gold moving higher and the dollar moving higher. The two were moving hand in hand. It was a rush to safety. Traders bought gold and the dollar to protect themselves.
Πολιτικής, οικονομικής.
Over 2009, 2010 has been a big focus on Greece and the integrity of the euro area. So when you get that type of focus, you tend to find the dollar does move with gold in the same direction. But more generally, if you look at longer time periods, it's more or less a reflection of dollar strength and weakness. So there is a relationship between gold and inflation, but it's not necessarily as strong as many people think.
The price of gold can also affect currencies in countries such as Australia, New Zealand, and Switzerland, whose economies depend on exporting commodities, including gold. Thanks for watching Bloomberg FX Masterclass. I'm Carol Biaggi.
Bloomberg FX Masterclass, brought to you by FxPro. Trade Forex like a pro.